Happy CPI Day to all those that celebrate this momentous occasion. The most important day of our life comes again. And we see a pretty positive reaction in the market post CPI. We see S&P futures grinding up to the second key gamma level pre-market. Let's take a look at some of the rates. Not a huge reaction in twos here. Initial reaction quite negative, then a bounce, then just sort of settling in a bit higher than where we started. 10's pretty flat, so not a big reaction in rates. Let's see what the euro's doing. Euro had a big drop, popped, and now back to where we were before. So it's really equities that are the most excited here. Some of the other intermarket dynamics that you typically see play out that are supportive, like dropping rates and a dropping dollar, not quite playing out so much pre-market. We'll see what happens during the cash session here. Ordinarily with a print like that, you would expect that rates would go up more, the dollar would go up more, we'd see equities under some pressure. Not quite seeing that. Now, part of that may have to do with other dynamics that play out in these situations, one of which is, you see people hedge ahead of the event. And then they have, the motivation to take those hedges off. So that could be some removal of hedging that we're seeing here. And we're still seeing Fed swaps pricing in that first rate cut by the Fed in June, so unmoved by this CPI data so far. We did see some increases in today's CPI reading in energy, particularly gasoline and food oil, as well as utility piped gas service. We saw some relief in food away from home and services less energy, including shelter and transport. Just looking at month over month levels and how they trended last month versus this month. So it's a bit of a mixed bag. It does make sense to see energy coming back. We have seen the price of oil on the rise over the course of February. We've seen a bid in heating oil, and of course, gasoline tends to follow the price of oil to some extent, depends on refining capacity. On the other side, food away from home coming down a little bit makes sense as well. So we'll have to parse this as the market opens. I think the initial reaction here is more to do with removal of hedges and equities based on some of the intermarket dynamics we're seeing. Take a look at the Russell here. Similar look, gap down, and then just rocketed and now consolidating. Gold actually had a nice little pop after the drop. It's starting to give some of that back here. Crude, not a huge reaction to the data overall, which makes sense. We'll go back to the 10-year rate. We're looking at the futures there, and we just see them settling now. So there was certainly a drop, implying that rates on the 10-year were initially going higher, and now we've sort of settled, so it's basically a break even. Let's take a look at the euro. The euro now coming back down, implying some upward pressure in the dollar. The yen actually had a drop and then a pretty powerful pop. It is also settling back down. Let's look at some of the heavyweight stocks ahead of the open here. Here's Nvidia. Nvidia had a drop and pop, and now it's rolling over a bit. Similar look with SMCI and Meta. Amazon still pretty strong here, comparatively speaking. Had that drop, but that pop hasn't stopped. Similar look with Microsoft as well. Apple, pop, but drop. So settling back down. Similar look with Google. Google looks like it's got some more room to the downside here, maybe 137.75 on that resting offer. And here's Tesla. Tesla is a bit of a basket case this morning, but we did see the drop and pop and now sort of the sideways consolidation. And finally, we'll round it out with semis. Semis, you just can't get it ahead of these things. They're just grinding higher pre-market after that initial drop. Go back to the S&P 500 here. OPEC crude oil output rose by 203,000 barrels per day to 26.57 million in February, led by Libya and Nigeria, despite fresh voluntary cuts. So that's interesting and certainly puts a little bit of pressure on the price of oil as you see more supply coming online. Looking for Red Book data. That's retail sales data year over year collected by Johnson Red Book coming out in just about 5 minutes here. We do see a little bit of a pullback after that initial positive reaction to CPI, which left some scratching their heads, particularly as the intermarket dynamics to support that move just weren't there. And again, looking at the way this reaction played out, to me, initially, it smells more like removal of hedging in equities. You get folks, and we saw it yesterday, there was a lot of out of the money put buying in SPX. There were some hedging flows in futures. You see that ahead of large event volatility catalysts. And then when the catalyst happens and it's not worse than expected, today's CPI was hot, but it wasn't scorching. You get folks that remove those same hedges. And so you have an addition of liquidity into equities. I feel like that's largely what played out, particularly given this pullback we're getting from that initial reaction. But we'll see. Let's see what the cash session brings us. And we're seeing S&P just getting a little bit of support at that volume weighted average price level that's calculated from the overnight session. We did see resistance around this gamma 2 level found by the advanced SPX options visualizer, and that has to do with the second largest level of total gamma exposure on the SPX options chain. Let's take a look at the NASDAQ here. NASDAQ, similar look as the S&P. It had that pretty sizable pop after that gap down drop. And you can say that's a gap down because, look, there wasn't a lot of transacting in that gap down. So there really wasn't much liquidity there. When you zoom out, and it's probably better seen on the S&P, but when you zoom out, you see how there's like no liquidity here at all? This often happens before an event volatility catalyst. You get this just disappearance of everything in the order book. Now, obviously, the goal of high frequency trading, the reason we allow algos in the market was ostensibly to provide liquidity, but they all disappear when you need them the most. So you get these crazy moves, and that's what that gap down was, right? Because there was really no liquidity until down there, just above 51.7750. And then you can see after the event, liquidity starts to come back, bring us into the present, where now it's starting to actually increase quite a bit as we get closer to the cash open. This is one of the reasons it's important to be a bit careful trading events, because you get these kinds of reactions in a low liquidity environment, which can exacerbate the scale of the move. Someone asks in the chat, what data points suggest that the Fed shouldn't cut in June? Well, I would say all-time highs in crypto, near all-time highs in stocks, near all-time highs in housing prices, some signs of inflation reaccelerating, PPI coming in hotter last time. We'll see what it does this Thursday. Services and manufacturing PMI prices paid in positive territory, suggesting that there is more kind of inflation in the pipeline. NFIB small business survey suggesting that they're going to be raising prices, about 36% of respondents over the next 3 to 6 months. That correlates pretty well with CPI with a bit of a delay. So there's some, I would say pipeline of potential positive inflation pressure. The other one was, average hourly earnings still remain higher than what the Fed would want to see, which does add some pressure as well. So I would say all in all, if the Fed's dual mandate really is price stability and full employment, even though unemployment's ticked up to 3.9%, we're pretty darn close to full employment. We've got 1.3 jobs available for every unemployed and insured person seeking work. So still a somewhat tight labor market. So you could say the jobs market, that part of the mandate, full employment, kind of okay. And then on the other side, price stability, it's hard to argue we really have price stability with some signs of inflation reaccelerating. So I'd say if the Fed really is honoring their dual mandate here, there's every reason not to cut. Now, there are other reasons that they would say that there is to cut, and it's going to have more to do with bank reserves and reverse repos coming down and them wanting to add some liquidity into the short-term funding mechanisms of the market. I think that's really where the rubber meets the road for the Fed. I don't think it's going to be them really looking at their dual mandate. I could be a little cynical on that. I am a bit cynical of central banks. Folks that follow me know that, but I do think that there is some level of potential policy mistake playing out should they cut. I think that's one of the reasons that gold and crypto have such a strong bid. And I think it's one of the reasons that stocks have just kind of ignored all of this, assuming that the Fed's getting back into a cutting cycle when none of the froth has really abated anywhere. We can see it again in crypto, in equities, in a lot of the meme stocks where call skew is absolutely blown out to the upside. We can see it in real estate as well, particularly the higher end housing that continues to grind up in price. So I don't see a lot of powerful reasons for the Fed to cut here. The economy is not in trouble. The financial system is not in trouble. And if inflation is starting to show some signs of a reacceleration, then, real rates are coming down a bit, which means policy isn't that restrictive. And then the last thing I'll add is if we look at various measures of financial conditions, we can see that financial conditions have actually eased since the Fed started hiking. So there's been such an offset from fiscal and other central banks like the Bank of Japan and to a lesser extent the People's Bank of China that financial conditions didn't even really tighten for more than maybe several months during 2022, particularly during the end of 2022. They got pretty tight, but now they're looser than where they were before the Fed started their tightening cycle. So I'd say there's every reason to not necessarily lean into cuts, but I think nevertheless the Fed likely will cut at least twice this year. Probably or possibly up to 3 times. I don't think it'll be what the market expects, which is over 3 times, but nevertheless, I do think they'll lean into that because they've already forecasted for it. They've already, signaled with some degree of certainty. Now we will get the Fed's summary of economic projections in their March meeting, which I think will be quite important. They'll give us their thoughts on where economic growth is going, inflation, and then the dot plot, which gives us a better sense as to what policymaker expectations are for interest rate policy. We also might hear a little bit more about their plans for their balance sheet. We've heard a number of different opinions on that, such as where RRP goes, that they start to slow down on quantitative tapering, or tapering the tightening, I should say, right? The other side is they've talked a little bit about selling mortgage-backed securities to actually fund some of the short end buying. So they would be actually shifting their maturities. Powell's also talked about shifting maturities to shorter maturities on their balance sheet. So I think all in all, we'll probably hear a little bit more about their balance sheet and what they expect to have happen there. That would be my thought for the March meeting, and maybe that'll provide some more clarity as to what they're thinking about, forthcoming cuts and why specifically they're thinking about them. Let me know if that helps with your question. Good morning, everyone. I have not heard of Lux Algo. Someone asks, do we use Lux Algo? I've not heard of that. You're welcome to share more about it. Certainly piqued my interest. And yeah, so let's go back a little bit further in time here, right? Let's go back to where this all started. So we do see the markets here, pre-market, giving up some of that pop post CPI, just finding some support at VWAP here. We did see some resistance at what has now become Gamma 1 on the advanced SPX options visualizer. And remember, again, when you have these events, you see liquidity disappear. There's no reason to be too aggressive ahead of CPI, because you can get these big gaps. You can get a lot of chop. And unless, you have some kind of way of managing your risk, which would mean like trading very, very small size, this type of a move can be quite jarring, especially given that you're not going to get any fills as the event is happening that are going to be ideal. So my thought on these types of things is to kind of let it settle out, see how the market reacts, and then look for your opportunity. I felt like this was maybe a little bit of an overreaction, and it had more to do with the removal of hedges. And I feel like we're seeing that validated to some extent. So just to go over that again for folks out there just tuning in, before you get a big event volatility catalyst like CPI or the Fed or otherwise, you're going to have large institutions that will hedge their books into that event because they don't want to necessarily suffer unmitigated downside risk. So they'll be buying puts in SPX. They'll be shorting, the S&P 500 futures or stocks or otherwise, wherever their hedging mechanisms are preferred. But most of it is going to happen in SPX options and in ES futures. And so when the event happens, and it's not the end of the world, like, yeah, it was a hot CPI, but it wasn't scorching hot, you can see this sort of violent move because those hedges are being taken off rapidly. Usually even algos are involved with removing those hedges. So they parse the data. They have the parameters that the trading desk was looking at for CPI, and they say, okay, wasn't as bad as it could have been. Let's get out of those hedges. And it kind of turns into yelling fire in a crowded theater, because then you got a bunch of different algos doing the same thing, kind of modeling that we need to get out. This wasn't a disaster. That becomes liquidity positive. You add a bunch of liquidity into the market, you get a bid. And then once that removal of hedging completes, well, you can kind of see what happens, right? You see a little bit of a rolling over. So again, we haven't gotten to the cash open. It's too early for us to say what the actual reaction to CPI is here. So we will be waiting. And I do like that 20-minute opening range to get a better reaction. Now, we just got Johnson Red Book year over year about 5 minutes ago. It came in at 3% versus last reading year over year was 3.1%. So that just says 3.3% growth at a nominal level of consumer buying at retail stores year over year. So overall, good news. Now, when you adjust that for inflation, it's kind of flat, right? The CPI just came in at, let's look at headline, right? Came in at 3.2% year over year. If Johnson Red Book is 3% year over year, then in real terms, it's down 0.2% year over year, right? So consumers are spending more, excuse me, but they're getting, in effect, the same or less because of that compounding inflation effect. That sounds pretty cool. Definitely feel free to share more about that opening gate trader if you have some screenshots or otherwise. And folks, one thing to be really aware of here, because I see this happen too often and people get in trouble. Don't assume that the reaction within like a minute to a data point is the reaction, right? So when you get something as important as CPI or the Fed or big earnings or any kind of data print that's significant, especially when it's happening pre-market or after hours, do not assume that the initial reaction that you see is the reaction. It's not like, oh, it popped, it must be good news. That's a little bit aggressive. We need to wait for things to digest because it takes time. Markets take time to process information. There's the bot reaction that we talked about, right? But then there are also the actual humans that digest the data and make positioning decisions on the basis of it. So when we're looking at it from that perspective, I think it's important to contextualize that decision-making process does not happen in 2 minutes. People don't parse all of CPI and they're like, boom, got it, know exactly what I'm going to do. The bots do that, and they're often wrong. Their human handlers sometimes have to go in and kind of adjust their positioning afterwards as well. So my thought is patience is a virtue around event volatility catalysts. There is no rush. You don't have to be in the CPI trade. You can look for the trade that happens during the cash session afterwards, particularly when you get this kind of crazy volatility in and out of, the CPI data release. Plus, as you get into the cash session, you're going to see improved liquidity, which means less slippage, better order fills, right? So it's a better, I imagine that today's trading session will be a little bit less volatile than 8:30 to 9. We'll see, but that was quite something there. You pretty much traded a 40-point range in a matter of 15 minutes in the S&P. So the lesson here is just with trade setups, whether you're intraday or swing time frame, patience really does pay off over time. There's no reason to try to get in every single trade, particularly around events where they can be kind of binary, and there's a lot of room for volatility due to those lower liquidity conditions going into the event. Now that CPI is behind us and we're getting closer to the cash session, you can see on the heat map that liquidity is building. Now let's zoom out a little bit and then we'll take a look around the market. We do see a really large level of interest below us here. This is that level where we actually saw a bounce earlier post CPI, just around 51.78. That was an area where there was a lot of hedging interest yesterday. It was the second most active area of put buying. So far we are seeing sellers ahead of the open kind of reversing this initial pop that I attribute to algos, largely removing hedges. The NASDAQ, let's zoom out a little bit so we can contextualize this. It's also looking pretty weak here. Now testing the point of control below VWAP. The Russell having another one of those days. It looks the weakest of the bunch. It's actually almost back down to the CPI lows. And then we've got gold continuing to slip. And we're just going to zoom out on all these charts to the CPI reaction just to kind of get a sense. Gold actually took out the CPI low. How about that? It's supposed to be a hedge against inflation. Inflation's heating up and gold is rolling over. I jest a little bit. My opinion on gold is actually that it's a uncertainty hedge, not an inflation hedge. And if you really study how gold reacts, it reacts better in times of fear than times of intense inflation overall. Otherwise, gold should be substantially higher than where it is right now, where it's, like $250 above where it was in 2011? And yet inflation has certainly debased the dollar more than that would suggest. Oh, we are seeing yields building in 10s here. Look at this. This is quite interesting. So pre-CPI, you had 10s gap down, right? This is the futures contract, so inverse is yields. So you had that big gap down pre-CPI, then you had a little pop off of that, right? Now we're going right back to that level. This is ominous for equities. This suggests that NASDAQ stocks especially should see some weakness. The euro, which is the biggest part of the dollar index, up, look at that, right back to the CPI lows. It was a little early to celebrate that move in CPI. We do have a 10-year auction coming up today, results posting just after 1 p.m. That will be really important to get a sense as to where participants are thinking about inflation after this reading. We'll take a look at some of these hot stocks ahead of the opening bell. Here is Nvidia on screen, rolling over from its highs, not looking quite as bad as some of the other areas, but still showing some weakness from its highs. Supermicro, everything's about silicon these days. Supermicro also rolling over a little bit, though not back to its CPI lows. Meta, same look here, pre-market. Amazon, we're going to, again, zoom out a little bit. Rolling over a little bit, not quite back to its CPI lows. Microsoft showing some weakness, similar look as the rest, not quite back to its CPI lows, but rolling over. Apple, just the struggle is real with this one. It is below its CPI lows. Google, yikes. Google well below CPI lows, just rolling over and now starting to stabilize a little bit. And our buddy Tesla above that key pivot of 177.77, testing it this morning and stabilizing post CPI here. And we are back to the S&P, which again, for now, we're just going to keep those CPI lows on screen. We know that they're here just around yesterday's warm put level and this 1,000 resting bid. So remember, when CPI came in, the market did drop immediately. I've got some folks in my YouTube discussing this and saying, you know, it should have come in, if it was hot, the market should have come down immediately. Well, it did. We got a gap down and everything post CPI. Then you had that pop, which again was probably the release of those hedges. And now you're seeing the drop come back in. We're back to basically where we were prior to CPI in the equity indices. And if we're looking at, the 10 years, we're actually testing those CPI lows, similar with the euro. So I would say that initial reaction is being faded. That initial recovery reaction, I should say. And we've got the opening bell coming up in just under 14 minutes here, folks. And you can see this point of control level here, this yellow line. This is the line in the sand. We cross below that. We are below where we were pre-CPI, and that's going to give sellers the chance to get a little bit more aggressive, and it puts this 51.78 level right on the radar. I would say, yeah, 51.97 is the point of control right now. So that is a level to watch as we get into the cash session. Things could evolve quite quickly after the opening bell because during that first hour of trading, you have a lot more institutional transacting. And folks, I want to just go out and say one thing that's really important. This is options expiration and futures expiration week. So that means you're going to have a lot more rolling of positions by large players that are somewhat price agnostic. Now, what that means is that technicals and probabilistic outcomes from certain types of trade setups, they don't have the same weight. They have less likelihood of manifesting as you would expect because you've got folks out there that are like, look, I got to move around like 20 billion of positioning. Doesn't matter what the price is. Doesn't matter what crayon line is there on the chart. Right. So that's the caveat I will say about Opex week is that it does not play out as you might expect versus other weeks because of all that position shifting that's happening. So let's take a look around some of the other markets here. We've got just about 10 minutes before the opening bell. Here's the NASDAQ. We're going to, again, zoom back out and look at that. We have been plunging back down to those CPI lows. We haven't quite gotten all the way there yet, but the NASDAQ has given up that point of control that it was holding. So that is a bearish look for our momentum leader. We watch the NASDAQ closely because it tends to lead the market up and down. Russell, boy, not looking so great. Similar look as the NASDAQ now. Just both of them really sagging back down, looking like they want to test those post-CPI levels. Gold took out the CPI lows and looks like it's rolling back over. You do have a large resting offer at 21.74 worth watching. It's acted as resistance so far. Oil getting a nice little pop here. Let's see where we are in relation to the CPI move. Just trying to recover in oil here. It didn't have a big move post CPI, but then after that, we saw this pull, right? We got down from 78 and change all the way down to 77.35. Now we're seeing about a 50-cent rally off those lows. 2-year note futures, this one's a real important one to watch. This is sort of a way of seeing in real time market expectations of the Fed. A 2-year note, if you look at its yield versus Fed funds, it tends to be somewhat predictive as well. So it's a great one to watch. You can also watch Fed funds futures, not for predictive value, but for understanding where market participants are thinking things are going to go. Very important distinction, by the way. But yeah, 2-year note futures are rolling right back over to those post-CPI lows. This is another sort of ominous sign because you're seeing the market tell us in no uncertain terms, this data compels us to bring rates higher, risk lower. I'm going to imagine as we go on to the dollar chart and one more, that it's also continuing to show strength versus the euro. But first we'll go to the 10-year. The 10-year taking out those CPI lows. So that's ominous as well. Okay, we want to be objective about assessing the situation. That initial reaction was likely hedges being removed. Now we're seeing more of what I call the real reaction. And yeah, euro almost back to those lows versus the dollar that we saw right after CPI data was released. The yen a little bit more stable comparatively speaking, but still pretty weak day. It had that reaction, that big draw in the yen. Then we had the pop. Now we're falling back down again. So let's look at some of the stocks here ahead of the open. Again, we're going to zoom back to CPI. Nvidia showing some resilience, but microstructure is distributive. You've got those lower highs and lower lows there. We'll look at SMCI. We're going to zoom that back out a little bit. Similar look as Nvidia, less liquid, obviously. And you got some random spoof for 8K on the bid down there at 1100. And look, we've got Meta showing that same sort of distributive pattern. Not quite as much transacting going on in this stock pre-market, but nevertheless, it had that drop, that pop, and now we're rolling over. Amazon, pretty similar look. Again, we'll zoom out, and you can see there is that drop, pop, and roll over. Microsoft, a similar look here, now getting closer to those post-CPI lows. And Apple. Apple's actually taken out those post-CPI lows and bounced a little bit, but overall looks kind of ugly pre-market. And Google, this one had that drop, popped, and then rolled over to significant new lows. It's still well above the 200-day moving average by about $3 or so, but this one's going to be one to watch. It had shown relative strength over the last couple days of trading. Now it's back to weakness. And Tesla. Tesla's just sort of stable here. It had the drop, it had the pop, and then the drop again. Now it's consolidating. We're going to go back over to the S&P as we are just about 6 minutes away from the open here. And folks, while you're watching, if you have any questions about anything you see on screen or what I'm discussing, you're always welcome to ask. It might take me a moment to get around to you because I've got about 4 different places that I'm streaming to right now. But nevertheless, I do want to make sure that I answer any questions and that you get some, some value, some learning experience out of this stream. My goal is to help you learn more about how I trade, but also how I think the markets work, so you can get a better sense as to how you may incorporate that into your process. And an important part of that this morning was talking about hedging and removal of hedging and how that can give us head fakes. And we saw that play out pretty clearly with the S&P and the NASDAQ. We saw it, the intermarket dynamics not support the moves that we were seeing in the equity indices and then them start to fade. So that's all important to understand in the context of, whatever time frame you're trading, but particularly shorter time frames. Just less than 5 minutes until the opening bell here. Fitch had a headline coming out earlier saying U.S. bank liquidity likely to remain relatively stretched until there is some shift in the Fed's monetary policy. And so the next major economic event scheduled today is the 10-year note auction. Results posting just after 1 p.m. this afternoon. And there was over 100 billion of Treasury auctions this week. Yesterday's 3-year auction went very well. Today's 10-year auction is 39 billion on offer from the Treasury. Tomorrow we have a 30-year auction with 22 billion on offer, and results will also post after 1 p.m. for that auction. I believe the 10-year will be pretty important today to get a sense as to whether this inflation picture shifting a little bit has an impact on what we've seen as recently being robust demand for U.S. Treasuries. Part of that robust demand likely has to do with the presumption that the Fed will be going back to an easing position, so some of these higher interest rates are more attractive. Got just less than 2 minutes ahead of the open. Cocoa setting another all-time high so far today. Just cannot stop running. Eventually, I feel like chocolate will be more valuable than gold if this keeps up. It's just absolutely remarkable. Do yourself a favor, pull up a monthly chart of cocoa. That parabolic move is extraordinary. There's nothing else in the commodity space that looks anything like it. Now, obviously, you can go into crypto and make analogs with Bitcoin, but that's a bit different. Cocoa's driven by hedge funds piling into speculative long positions combined with real world scarcity factors from unpredictable weather conditions damaging overall harvests. So this has led to a mania in the commodity. Someone asks, what's my view on gold and silver now? It's a great question. So I am constructive on precious metals, but my view is that I would be a little bit more constructive on silver and some of the better run gold miners. I'm looking for them to catch up to gold, and I'm sensitive to rates in the dollar. If rates start to move higher, if the dollar starts to move higher, I think that could put some some pressure on precious metals and possibly alter my view there. But as long as we see, rates and the dollar either moving sideways or ideally lower, I think the whole precious metal space does have some room. There's also, again, gold, silver, hedges against uncertainty, things that are bought in a more an environment where there is some modicum of fear. I don't think that fear is coming in from the markets so much as the fear of a Fed policy mistake and the fear of geopolitical tensions escalating. So with that backdrop, that could continue to provide a bit of a bid for precious metals as well. Let me know if that helps. In terms of, someone asked me, is it time for natural gas soon? I think that's a great question. So if we look at it from the perspective of seasonality, natural gas tends to do well in April. So I'd say a little more patience, but we are getting close to a time where there could be opportunities. Now, personally, I prefer to trade the companies in the space, like a Diamondback, symbol FANG, versus the commodity itself. But nevertheless, April is more constructive for seasonality in natural gas than March or February or January. The opening bell has rung. We are seeing a little bit of a bid off the open here. Remember, as we are in Opex week, you do have some of those decay flows, right? Theta decay is driving down the value of SPX puts. So in that first hour of trading, you get a little bit of a bid, all else being equal, with those flows coming through. On the other side of it, however, there are reasons for folks to potentially want to sell into this equity market. So going to be a bit of a tug of war here. We'll see how it goes. I like to look at the 20-minute opening range. The big caveat, again, is this is Opex week, so a lot of price agnostic players moving big positions around, meaning those statistical probabilities of the outcomes that we may be used to are subdued. And we're going to take a look around other parts of the market here in just a moment to get a sense as to how this opening is shaping up. And then within about the first 10 or 15 minutes, we'll also get a better idea of where options interest is in SPX, and that can help to shape part of the trading day as we get a better idea of where institutional interest is in price and how much of a range there is. So far, we can see buyers pulling up the point of control into that cash open. And we do see some liquidity beginning to build above at 52.20. That's just above that key gamma 2 level. Now, again, a quick review of CPI month over month. There was an increase in energy prices despite them dropping year over year. We did see a drop in food away from home, and it was overall a mixed picture. So I'm going to go right back into it here. Shelter and transportation, their rises also eased a bit month over month. Now, that may be to some degree ephemeral. Transportation costs are, they're sensitive to energy going up. There might be a bit of a latency, but those transportation costs could come back up. We also see shelter slowing month over month, but home prices, particularly middle and most especially higher end home prices, continue to rise, which could put some delayed pressure on owners' equivalent rent surveys with about a 5 to 6 month lag. And there was a small buy side imbalance going into today's trading session, about 33 million on the buy side. I don't really look at these opening and closing imbalances with too much interest. All I know is that other folks do look at them, and so they can sort of kind of maybe matter. All right, so let's hop around. We do see, again, that tug of war idea I was talking about between buyers and sellers on the open here. You've got those passive flows accumulating back S&P futures contracts as hedges are being losing value, but some hedges are also being removed. But on the other side of that, you do have real sellers looking at that CPI acceleration and saying, gee, that's not what we wanted to see. So bit of a tug of war. Let's look at the NASDAQ here. NASDAQ looking worse than the S&P overall, and really starting to have a look like it wants to come back to these post CPI data release lows, that gap down level. So we'll be taking a look at that. That's going to be just around 18,212 on the NASDAQ front month. That's June now, rolled over everything over to June for equities. Russell also has that similar look. It is really just weakening into the opening here. Gold also rolling over a little bit into the open on that hotter inflation data. Again, gold not really an inflation hedge, more of an uncertainty hedge. And crude oil rolling over as the point of control was pulled lower by sellers. We got a little bit of a pop there into VWAP and now rejecting, and we have a large area of resting liquidity on the bid around 77.25. We've got 10s here. They're also weakening. That implies rates on the long end are starting to move higher, and that makes more sense with the type of CPI print than we had than it to see rates actually show relief, which was the very initial reaction, right? Within that first 15 minutes, you had a violent gap down and then a pretty decent recovery, sort of like a beach ball being pushed underwater and then popping. But now we saw that pressure released, and we're starting to see the real reaction. And the real reaction is this data wasn't so great. 10-year has a similar look, albeit pushing below the post-CPI data release lows. And you can see it in the 10s too. All that liquidity vanished. So really, no matter what you're trading, if it has some proximal relationship to CPI, it sees liquidity disappear, right? So during that trading event, it's important to be very careful. This is why trading the event, if one is going to do it at all, should be done in very small size with wider stops because of exactly this type of price action. Euro on screen, back to CPI lows, implying the dollar is firming up here. We'll take a look at the yen as well. Same look, not quite back to CPI lows, but weakening nevertheless. Now, let's take a look at everyone's favorite stocks. Nvidia, yikes, that open. Nasty business there. Not quite gapping down to post-CPI lows, but that was quite a drop there, just right off the open, about $7. SMCI, even nastier there. Not quite back to the CPI lows, but a big drop in SMCI. Meta, big drop in that one on the open as well, and it is back to the CPI lows, actually starting to take those out. Meta was a leader, so seeing it behave this way is slightly concerning. Amazon, let's zoom out a little bit here. Close to those CPI lows with liquidity building around that same area. And Microsoft actually ignoring the rest of the pack. Look at Microsoft's relative strength. That is very interesting. Maybe there's a specific news catalyst here, maybe not, but folks are taking advantage of Microsoft's dip and actually buying it, and it is ignoring its peers. Apple, yikes. Oof. Apple handily taking out those post-CPI lows, liquidity building below, and really just this thing is just slipping after the market opened. Google, look, Google had that huge drop. It extended the post-CPI drop, took that out. Now we've gotten right back up here. Very interesting price action in Google and Microsoft today. And Tesla, well, Tesla's dropping further. It had that period of consolidation. It was making up its mind about the next move, and we can see it's decided now. It's well below that pivot of 177.77. That's the line in the sand where I would get bullish above, bearish below. Bearish of Tesla based on the technicals, and look at all that liquidity building below as well. Obviously, people want to buy it, but they want to buy it at lower prices. And S&P here looking weak. We are close to those CPI lows and getting closer to that level of potential support. We've got about 1,000 on the bid at 51.78, just around where there was a lot of interest in SPX puts yesterday as a part of those hedging flows. And folks, if you're enjoying the stream, feel free to retweet it. It's just on the top of my Twitter feed here, or you can share the YouTube link you're watching on whatever social venues that you're participating on. The more, the merrier. Yeah, you're welcome. Thanks for tuning in. Appreciate the positive words. I always enjoy watching the markets. I felt like the reaction today post CPI was a little bit silly. That's why I wanted to hop on mic a little earlier than I usually do for today's stream, to just provide my 2 cents that this isn't exactly what it appears to be. And indeed, we are seeing that play out. I mean, that was hotter than expected data. And when the market reacts, you know, it doesn't necessarily have a reaction function that can give us an accurate sense as to what it thinks within 2 minutes or 5 minutes of the data release. So that's why I like to caution getting too excited about those very quick snap reactions, because it can be the removal of hedging more than a sincere view being expressed. And I think today is a perfect example of that phenomenon. People hedged into CPI when it wasn't an end of the world print. They got rid of those hedges probably algorithmically. Those algos fought each other a little bit, caused that big bid off the lows. But the reality is it wasn't great data, and there's every reason for real humans to sell into that a bit. We've got about 7 minutes left till we'll be forming that 20-minute opening range in S&P and NASDAQ here. We have seen some iceberg distribution here too. Overall, though, I do get the sense that this is not a particularly happy market. It probably has room lower from here. We see that also in these intermarket dynamics. The 10s easily below that post-CPI low. The 2s getting closer to it. And then, of course, we have the euro over here also taking out that post-CPI low. Those are all dynamics that suggest there could be some more downside in equities as well. Someone asked, do I record the stream in order for it to be watched later? Yeah, so it is automatically recorded. You can watch it on YouTube, on Bookmap's YouTube, my YouTube, and on my Twitter. I think the YouTube ones will be around like indefinitely, and I think Twitter purges their video recordings after like 30 days or so, if I'm not mistaken. So probably best to check it out on my YouTube under the live streams or under Bookmap's YouTube under the live streams archive. And if you find this, valuable for later learning, that's awesome. That's what I'm all about. I hope folks find value to watch it once, maybe watch it again later, or at least, to kind of take some notes as to what all is being shared. I've been trading since 2005, and I try my best with everything that I'm doing to help you avoid some of the pitfalls that myself and other earlier traders make. That's a big part of why I do what I do, to share that knowledge and to help folks avoid some of that pain as well, which is one of the reasons I talked about head fakes this morning, because I've seen a lot of people get trapped in that type of trade and get their head ripped off, getting too bullish on a reading like today, and then it just goes absolutely the other way. And you can see those large bubbles here. If you're looking at the Bookmap heat map here, those are delta prints. That's showing you that there is aggressive selling. Just like the large green bubbles are showing you there's aggressive buying. You can see overall, this tape has been full of aggressive sellers. They are dominating the tape so far. So just to give you an idea of the mood, people want to take profits here. This is mostly a long-only world. Like, even the most aggressive bears out there are still net long. There's very few people that, across all their equity exposure, retirement accounts, taxable accounts, trading accounts, whatever, that are net short, right? So most of the action that you see on a day like today, this weakness, is more profit-taking. It's not just people leaning into shorts. And most of the shorting that you see by institutions is actually hedging their book, right? So just important context, because I know there's this idea that like bears are just always short and they just always are imploding when the market goes up. The reality is that some of the most ardent bears out there are net long, very net long, but they're hedging that long exposure by shorting other areas of the market. Just thought that was something to talk about as we wait for this market to kind of give us our 20-minute opening range. Just about 4 minutes away from that, we can see we're getting closer and closer to that post CPI low in the ES contract for June. And looking all but inevitable that that resting bid at 51.78 gets taken out by sellers here who are still mounting a rather aggressive pull. Let's take a look around the market, see what else is going on here. NASDAQ below the CPI lows. It is our momentum leader. That portends to the S&P following. Russell, similar look, but finding just a modicum of support there so far. Gold consolidating after making a new low. Crude trying to make a push higher here. 2-year note futures continuing to grind lower. 10-year note futures, very similar look, a microstructure downtrend of lower highs and lower lows. And the euro, same look there, no big surprise. The dollar is strengthening after yields are rising on the back of that print. Nvidia continuing to fall. Nasty pull in this one, now down $15 from the cash open. It showed some strength into that cash open, giving that all up now. And we do see resting liquidity building below in Nvidia. This stock has incredibly stretched skew towards the call side. So if we look at Nvidia's skew, you can look at various websites to do this, like Market Chameleon. You can see that it is so thoroughly inverted towards calls that you get passive distribution. It's the opposite of what we talked about with SPX puts, right? If market makers are selling SPX puts, as those puts lose value from theta decay and otherwise, they're able to reduce their hedges by buying back futures. Well, in stocks, if I'm selling contracts as a market maker to someone that's buying calls on Nvidia, and those calls are losing value due to theta decay and the price dropping, guess what? I get to sell shares into that. I get to reduce my hedges. And on Opex week, that activity intensifies, and we're certainly seeing some of that, which means the offsetting flows, the buying of shares and calls need to more than offset that weakness. And so far, they're not. Long-winded way of saying Nvidia could have a little bit more downside from here. SMCI taking out 1100 to the downside. And we can see that's right close to those post-CPI lows. Meta trying to stabilize a bit, but, you know, it did take out its post-CPI lows earlier. Pretty volatile trade in Meta so far. Amazon looking pretty nasty. Let's see where it is in relation. Yeah, it's taken out those lows, or very, very close to it. And Microsoft, we talked about the strength earlier. It is giving that strength up right now. So it had that sort of counter NASDAQ bid. The NASDAQ was rolling over, Microsoft was rallying, and now we're starting to see Microsoft give that up a bit here, but it's still relatively stronger than its peers. And Apple just can't get out of its own way. Big resting bid at 171, seems like destiny there, and potentially even 170. Lots of resting liquidity below, wanting this stock lower. There is, of course, a fair amount above, but the trend is your friend, and these act more magnetic when they are on that path that the trend is following. Google showed some strength up to 139, rejected there. It did take out that resting offer, but then it came right back on the tape, and we can see that stock rolling over like Microsoft. It showed some initial strength. It's not able to hold on to it. And then there's Tesla here, which is just absolutely rolling over from the open. It looks a bit like Nvidia. So we're going to go back all the way to the S&P futures here, and we are just above that level of the CPI, post-CPI lows. We do see a lot of call buying in Tesla this morning, as well as Nvidia. So we've got Tesla 170 sweeps for June 21st, 121,000 in premium paid. Got 175s for March 15th, 142,000 premium paid for those. Got 177.50s for this Friday as well, 311,000 in premium paid. And then Nvidia, 1,000 strike for this Friday, 143,000 in premium paid. And a 1080 strike for May 17th, 318,000 in premium paid. So a lot of activity in Nvidia. Going out to this Friday again, 895 call strike, 1.15 million in premium paid. And Nvidia options just lighting up the tape again today. I mean, I could go over all of them, but we're talking about millions and millions of premium paid for that and for SMCI. So a familiar theme. Semiconductor calls are all the rage, even though we're starting to see a lot of weakness here. I'd imagine it'd be even weaker if there wasn't that kind of bid in the semiconductor calls. Meanwhile, seeing S&P bid off of that 5178 level so far and right into the midpoint, we do see our initial calls and put flows. So we're going to zoom out so we can see what the SPX options visualizer is seeing today on the tape. We can see that hot put building much lower from here, around 5126 on ES. The warm put around 5163, now moving lower. Now moving lower. We're seeing those flows build into that hot put too. That is the most active option on the chain, and the put-call ratio favors puts as of this moment across the entire chain. That is why there's that asterisk by the 3K. So that just suggests that there is a renewed interest in put exposure for the purposes of hedging and probably to some degree downside speculation. But on the other side of it, when we're looking at unusual options flows, there's about 80% more going into unusual sized call buying and sweeps in single stocks and ETFs than in puts so far. Yeah, you're very welcome. Thank you so much for the positive feedback. Really appreciate that. And glad to hear that my explanation about removal of hedging helped to contextualize some of what we were seeing this morning. TQQQ calls coming through, about 500,000 in premium paid for the April 19th 70 strike. That's the triple leveraged NASDAQ ETF. And interest growing in Baidu, June 21st, 125 strike calls, 183,000 in premium paid there. Let's take a look at our friend, the NASDAQ. Getting a bit of a pop off its lows, climbing back above that post CPI gap down so far with a decent amount of volume. We see CVD, or cumulative volume delta, starting to tick back into the positive over the last half hour of trading. Let's take a look at the Russell. Kind of a similar look as the NASDAQ here. And also CVD creeping back into positive territory. Gold just consolidating here after those earlier losses. Again, really large resting offer at 21.74. This is not a particularly liquid contract. So when you see that much on offer, it definitely catches my attention. And we can see it acted as resistance not once, but twice. So a little bit too much supply for buyers to feel comfortable pushing through. Crude climbing back up here above the point of control and just testing VWAP from below. You can see cumulative volume delta pushing back into positive territory over the last, let's call it 40 minutes or so. Starting to look more bullish. And we do see a really large resting offer in crude above us at 79. Twos starting to stabilize after that draw. So we're starting to see rates stabilize a bit higher than they were before CPI. Similar look with those tens. Still below that CPI low. And similar look with the euro stabilizing a bit above that CPI low, not by much, but again, suggesting the dollar showed some strength here post CPI. Nvidia getting a little bit of a bid after that violent drop. Still looking like a microstructure downtrend with lower highs and lower lows unless we start to see a push above 878. SMCI looking a little more constructive than Nvidia, looking like it's trying to base, maybe reverse here, but seeing some resistance at VWAP. And Meta, actually nice reversal here, a W-shaped bottom now pushing above VWAP. And Amazon comparatively weaker than its peers, but starting to show a little bit of strength, not a ton of conviction in that trading. Microsoft pulling back up. And Apple just sort of moving sideways here. Not a lot of excitement in this stock. Google looking a lot like Microsoft, trying to get right back up to this area of resistance for Google. That's going to be around 139, where there's that very large resting offer. And Tesla looks like it's trying to put in a bit of a bottom here. We'll give it a little bit more time to bake. I'm going to say it needs to push above 174 and 175 to really convince the market of that. And let's take a look at SMH. SMH, nice reversal on this one. Right back above VWAP here as well. So if we're contextualizing that opening range in the S&P, we can say that the bottom of the opening range is going to be around this same level where there's that large resting bid. Top of the opening range is going to be around 52.21. So we're still waiting for a move outside of that range. We haven't quite had it yet. So we haven't really had anything that gives us a sense as to what kind of trend we may experience. And again, big caveat, big disclaimer, it is Opex week. So these opening range probabilistic outcomes are a little bit subdued. They're less likely to be as predictive as they would be under normal trading conditions on a non-Opex week. Someone's getting bullish of Russell, about 455,000 in premium paid for June 21st, 215 calls. Pinduoduo 140 calls for May 17th, 102,000 in premium paid for that one. A lot of excitement around their Temu platform. and pretty decent range today, pretty much a 40-point range. So if we do get a break one way or the other, we could see some momentum continue into that. Capital One Financial, 140 calls for this Friday, 250,000 in premium paid. Reddit looking for a valuation of about 6.4 billion on its IPO. Some saying the valuation is too cheap, others arguing it's too expensive for a company that is yet to find a way to make profits. An inverted yield curve is no longer a reliable indicator for a recession, according to 22 of 34 strategists polled. Do you see the S&P futures just pinging up back to this point of control? We see the midpoint coming back on screen, indicating there's a relative balance between puts and calls here, which we can see. While there is a little more heaviness to the put side of the equation, it's not enough to say that this is a market that's out of balance, that it's an auction with, that much more demand for puts. So that's why the midpoint is coming on screen from that SPX options visualizer that I built for Bookmap, which does align right here with VWAP. Often there is convergence that we see. That's one of the key themes that I like to talk about. And so this is telling us it's a market that's in relative balance right now after that initial sell. Let's take a look at the NASDAQ and see how it's faring. Very similar look in the NASDAQ as the S&P. We also see there is a resting offer building above at 18,400. NASDAQ climbing above VWAP and now challenging the point of control. Russell, very similar look here, although seeing some selling pressure around that convergence. And gold starting to get a little pep back here. Still watching that really large area of resting liquidity at 2174. That has been resistance twice now. Will the third time be the charm if we get there? I think it probably will be. 79 on crude, that area of interest continuing to look attractive. Let's just zoom out a little bit more. Yeah, that's really the largest amount of liquidity on the book where the trend is heading. So I think that's important to watch that level, that 79. Again, we're watching West Texas Intermediate crude, that contract in CL. Twos starting to look like they're consolidating, possibly looking like they want to maybe make a little bit of a push higher here. Similar look in tens, but overall, these gave back their post-CPI gains. Euro, a little bit of a pop, but now starting to look a bit saggy here. Again, this is about 70% of the US dollar index weighting, so it tends to matter quite a bit. And Nvidia, really recovering very well. A lot of those options flows that we've seen coming through, helping to provide some support. Options really are the tail that wags the dog in this market. There's so much more volume and notional traded in single stock options and index options than the respective underlying in stocks and futures. So, if you compare, say, the S&P 500 index options trade alone, it's 1.2 trillion of notional trading every day. All of equity futures put together is 400 billion. So a lot more interest in options. It makes sense also from the context of margin rates going up. So if you want to get a better price on leverage, options make sense to express that view. Let's look at SMCI. Boy, you wouldn't even know there was a drop if you blinked. It's come right back to where those prior levels were. And SMCI and Nvidia options have been absolutely hot all morning long. So not a huge surprise seeing these recover. Meta also recovering. Nice W, just pushed right through all those areas of resistance, right back to that point of control. Amazon, similar look as well. Really nice V-shaped bottom recovery on that one. Unusual to see. Nevertheless, there it is. And Microsoft climbing to new highs and taking out that large area of resting liquidity above at 410. Apple just kind of ignoring its peers, looking a little bit more constructive, but very, very lackluster in comparison. And Google no longer showing that same relative strength that Microsoft was, but nevertheless still looks better than its peers overall. But the comparison between Google and Microsoft, well, you can see which one's really getting the attention of buyers today. And finally, Tesla ignoring the rest of the pack and heading lower, really looking like it wants 172, potentially lower than that. The company continuing to struggle with narrowing margins, slowdown in sales, sabotage of its gigafactory in Berlin, and increasing competition from companies like BYD. So Tesla no longer a retail favorite. Really, Nvidia has become the retail favorite. So I was hoping that we would see an opening range break one way or the other while on stream. We're really not seeing that. We have a really big range here. We can see it on screen. So top of the range, let's just call it 52.10. Bottom of the range, about 51.78. We're really looking for a decisive move one way or the other to qualify some kind of trend. If we don't get that, we just may have just sort of a choppy trading day, which would make a lot of sense for Opex week. Let's take a look at the NASDAQ, see if it's giving us any interesting signs or signals here. Similar with the S&P, large opening range, no real break one way or the other yet. Although we do see CVD continuing to build, showing there is more buying interest in the NASDAQ. Russell comparatively looks not great. Seems like it wants to roll over here a bit. Also another one where we haven't seen an opening range break one way or the other. Going into rates, we could see just some modest recovery in tens, and the euro, similar, just a slightly modest recovery off of its lows. So those intramarket dynamics still providing some weight for equities overall. Nvidia 200,000 in premium paid for the 900 strike for May 17th. So still a lot of interest in those Nvidia options here. SMCI 108,000 paid for this Friday's 1150s. So absolutely interesting day. Maybe we're going to see the S&P start to pierce the top of this range here. Let's keep an eye at 52.10, see if we can build acceptance above that level and make a push. That would be certainly surprising with the intermarket dynamics we're seeing, suggesting downside being more likely, but nevertheless, this is the market we're in. So I want to thank everyone for tuning into my stream. I'm going to go ahead and wrap it up here. You can always watch a replay of it later on YouTube or Twitter. And I want to thank Bookmap for hosting me on their platform for this as well. If you want to learn more about Bookmap, check out TraderAid.com/bookmap. Scroll down to the specials. You can get up to 40% off. You can also check out my plugin, the SPX Options Visualizer, at TraderAid.com/SPX. That's TraderAid.com/SPX. And if you'd like to learn more about TraderAid, visit us at TraderAid.com. You get up to 20% off your first month or quarter with the code Mayhem20 at checkout. Thanks again, everyone, for tuning in. I'll be back next Tuesday at 9 a.m. to stream more on Bookmap.